Welcome to the All Financial Hour podcast with Steve All.
Volatility, and you talked about climbing up a mountain. It's sort of like the market, right? The market climbs up the mountain, and when it starts to go down, you better get out of the way. That's kind of what's been happening earlier this week. It trickled down a little bit. People started seeing red and panicking, and kind of like we were talking about before the show, it kind of went up a little bit, then down a little bit. So it's kind of been one of those times where, is it time to panic? Especially for those out there, a lot of them, I hate to say it, but boomers out there, you get a little, addicted to growth. You get a little too excited in the stock market. Is it time to pull back and be defensive right now?
Well, I look at it more to the point of, I've talked about it before. Volatility is usually a result of uncertainty in the market. We have had a lot of 1-point moves or more in the last 10 to 12 trading days. And to me, that's when volatility kicks in. And I was reflecting back, and I can't remember, it's 2015, 2017. It's like 15 out of 20 days were more than a 1-point move, positive or negative. Some of them were 2s and 3s like we're getting here right now. And it's like, holy crap, what's going on? But that's, like I said, it's the uncertainty that's going on. What happened to make things uncertain? Well, we got a Federal Reserve. We're not sure what they're going to do. Everybody thought they might lower, then they're not going to lower. Now people are saying, well, we ought to have an intermediate, before their next meeting and bring them all in and lower the rates because the economy, bad, worse, uncertainty. The presidential election. For the first time in history, we had an ex-president running against the current president. So there wasn't as much uncertainty because if Joe Biden was reelected, we have a pretty good idea what he was going to do. He was going to continue the programs he already had. And if Donald Trump gets elected, he's going to go back to the programs he had when he was president. So it took some of the uncertainty around it. Then all of a sudden now we got Kamala Harris. And we're not exactly sure what her thought process is in the business world, economy, all these different things. So it brings back that uncertainty. And I think that's where you start to look at the volatility. But as you put it, it's that capacity. Do people have the capacity for risk? It's a funny thing. I ask a simple question. On a scale of 1 to 10, if 1's being I'm as conservative as you can possibly be, and 10, I'm as aggressive as you can possibly be as an investor, and you couldn't pick 5, what would you pick? They said, well, I would have picked 5. And I said, that's why I say you can't pick 5. You need to know whether you're higher or lower. But do you know when I asked that question is very, very important. When markets are way up, people are 6, 7s or
Absolutely,
more.
Yeah.
When markets are way down and we have the craziness that's going on with the volatility, they become 4s and 3s. So it all depends on what's going on out there. And that's where we start to look at it. I believe that your investments should be based on need, not greed. Give me the best return that I can possibly get with the least amount of risk possible. Mike and Dorothy had come in. They were as aggressive as probably any of the investors I've ever seen. I asked him, I said, Mike, why are you being so aggressive? He goes, well, I got a certain number in my head that I want to hit. And I went, okay. So you have the capacity to take risk. And your attitude says, I can be as risky as I can. But Mike, do you need to take the risk? And he kind of looked at it and he said, no, not really. Because then I follow back up with anybody that comes into the office. And they're more a risky investor, because I know there are risky investors out there. And I just look at them. I said, if your portfolio went up by 20%, would that change the way you're going to retire? They say no. I said, what if it went down 30%? Would that change the way you retire?
Of course.
Probably not for a lot of the people that we have as clients. But psychologically, you are 100% correct. Yes, it would. Because that pillow that they have would not be as great. So that's when we look at it. Do you need to take all this risk? I always like the old 3 Ps. Steve, I want to participate in the market if the markets go up. If you can get me a predictable income, that would be nice. And then, I want to be protected. And that's what I believe that's available out there today. We have the availability and assets available that say, if the markets go down, I don't take a loss. But if they go up, I get to participate in them. And I think that's where we have to look at this. Yes, I still need a return in retirement. I can't put it all in cash. But let's protect what we can. And I believe having two things, the asset protected, and then also having that investment methodology using non-emotional, methodical, and mathematical approach to the questions that everybody asks themselves in times like this. Is it time to hold? Is it time to sell? And if I have sold, when is it going to be time to re-enter the market? Give me a call now if you're concerned about the volatility of the market. Let us run that risk-reward analysis and show you the different things that could be available to you as the investor that can help protect and participate in the market.
Steve, I ran across an article that talked about the benefits of annuities for not only the client, but also the financial advisor. It said annuities are really good at generating guaranteed income and provide a structured way for advisors to approach the challenge with their clients. Yet, many advisors, they don't offer annuities. What's the deal here?
Well, for me, I always put it, I know somebody just grow horns when we mention annuities because everybody's got a horror story. Uncle Joe did this and they kept his money or something. Everybody's got a horror story about annuities. And as I put it, when somebody comes to me and says, Steve, I hate annuities, I just kind of look at them and I go, I don't like a lot of them either. Which kind do you don't like? And I get that deer in a headlight look coming back at me. It's like, what do you mean? What kind don't I like? Because there are actually 4 types of annuities out there. There's the single premium immediate annuity. It's where you take your money and you take it to an insurance company and you trade your money for an income stream for the rest of your life. That did cause problems a long time ago when all of a sudden somebody died a year or two later and the insurance companies kept the money. So that was one of the strikes against the insurance company. So to help fix that, they have 8-year certains, 10-year certains. They have different types of a contract. If that's all you're looking for, is I want to trade my money for a guaranteed income. That's a single premium immediate annuity. There's a fixed annuity out there. Those fixed annuities, they look a lot like CDs, but they're not guaranteed by banks. They're guaranteed by insurance companies. They're going to say, I'm going to pay you a rate, an interest rate, for a set amount of time. Fixed annuity. Again, the guarantees are from the insurance company. The advantage of a fixed annuity versus a CD, CDs, if it's in a non-qualified account, the interest on the CD is taxed every year whether you receive it or not. Within an annuity, the gains are tax deferred until you take them out. So slightly different when it looks at that. There are variable annuities out there. Variable annuities, your money's in the market. They look a lot like mutual funds, but they're called sub-accounts. So you are going to have management fees. You are going to have different fees inside of those variable annuities. So you got to be a little bit more careful on that. What are the fees? Then there's the fixed indexed annuity. In the fixed indexed annuity, your money is not in the market. It cannot go down due to market volatility. To have a floor of 0, can't get a negative. Sometimes there are limitations on how much you can make, caps up to a certain percentage. Participation rates, I get 60%, 80%, 225% of whatever the index makes. The thing that I think most people get caught around a lot when it comes to annuities are the riders. Income riders. Income riders are there for a very great person. And, income riders are there for a very great reason. As you put, most people like guaranteed income.
Absolutely.
If your expenses are $5,000 a month and your income's coming in are $4,000, you got a $1,000 gap, and you change that to wherever it fits you. What if you could set aside part of your money to fill that gap? Would it make sense? Yeah. For a lot of people, it would. I want to guarantee my lifestyle. Then the money that's over here in the markets are for the extras. Help cover inflation, do those types of things. So that personally funded pension, I'm going to take some of my money, I'm going to give it to an insurance company, possibly turn on an income 3 to 4 years in the future if I don't need it right now. And then I can't outlive it. If I have a spouse, I could get it for both me and my spouse. So I think that is an absolutely wonderful thing. And I don't know why people don't do more of it. The reason being is what? One, there's only three things that count in retirement: income, income, and income. And as long as I've got that income, those are the things that are important to a lot of people. What I hate to see is when I see somebody that's got a great pension, they have a great Social Security, they live a very modest lifestyle, and they have an annuity with an income rider. And they're going, Steve, I don't really need the income. What do I do now? And that's what I'm saying. So if you've got an annuity and you haven't, it's got an income rider on it and you haven't turned it on, give me a call. Right now, interest rates are higher, so it might be able to be replaced to do something that you would really want to do with that money, because you really don't need that additional income guaranteed coming in every month. Could it be done with something else? But what if you want one of those personally funded pensions where you set aside some of your money to guarantee your lifestyle? Call, ask about the annuities. Right now is a wonderful time. Interest rates are higher. So therefore, caps are higher. It takes less money to buy you that personally funded pension. Give me a call now. Ask for an annuity X-ray, and we'll figure out how an annuity might fit for you.
When it comes to planning that first appointment with you, what are we going to get out of it? And most importantly, what are you going to give our listeners that the guy down the street isn't able to?
Well, my first thing is I want to know what your wishes, hopes, and dreams are, because I don't care who you are. Everybody that comes into my office has different wishes, hopes, and dreams. There's not one plan that fits everybody. There's different parts to all of them. So when we come in, we are going to ask you to fill out a data form. I'm going to need to know what your incomes are. Why? Because income planning, I think, is one of the most important things that people are looking for when it comes to retirement. How am I going to replace my paycheck? That's what we believe is very important. That's the first thing that we're going to go over when we go to it. Then we're going to look at risk reward. How much risk are you taking? Do you need to take all the risk that you're currently taking to stay retired? Most people have never done a Monte Carlo analysis to find out what their chances of a successful retirement are. And I think that's very important to have in it. We're going to talk about legacy planning. Most of us didn't plan on handing assets down to our kids, but we probably will. So we want to look at it, how can we do that as efficiently as possible? So we are going to look at your taxes. We are going to look at your current investments. We are going to look at your Social Security if you haven't taken it. And then we're going to do an analysis around that. We're going to bring you back a couple weeks later to go over that analysis so that you have a better idea where you're at in your retirement journey.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisory requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.